Welcome back. Japan just saw its biggest one-day move in 3 months, the Nikkei 225 surging 3,191 points, closing at 72,366. But here's what the headlines won't tell you. This rally is happening with Williams percent R at negative 0.6. That's not a typo. We are at the absolute extreme of overbought conditions. The last time we saw readings this stretched, the Nikkei dropped 4,000 points in 7 days. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, including the one number that completely invalidates this entire bullish structure. Session bias, strongly trending, but dangerously extended. The daily, 5-hour, and 1-hour trends are all flashing strong buy signals. The monthly and weekly trends are also strong buys. That's every time frame aligned, something we rarely see outside of panic buying episodes. But let me be crystal clear about the invalidation level. Write this number down. If we break below the daily pivot at 70,429 today, the entire structure resets. That's the line in the sand. Above 70,429, we are still in a bullish regime. Below it, and everything changes. Here's what the herd is doing right now. Retail traders are piling into Nikkei calls at the fastest pace since January, convinced this is the start of a new leg higher. But institutional positioning tells a different story. Futures flows show hedge funds adding short protection above 72,000. They are betting this rally exhausts right here. Let me walk you through the structure from the top down. Weekly time frame. The Nikkei is trading a massive 15,897 points above the 200-week moving average at 56,469. That's a 28% premium. The 50-week MA sits at 65,269, and we are 7,097 points above it. This is extreme extension by any measure. The ADX reading of 38 confirms the trend is strong, but here's what most traders miss. Strong trends with high ADX tend to accelerate into blow-off tops. The question is whether we are at the blow-off stage or just the beginning. Daily time frame. The MA configuration is textbook bullish, price above all major moving averages. The 20-day MA is at 68,781, the 50-day at 65,269, the 100-day at 61,594. That's a beautiful bull stack. But the RSI at 67 is knocking on overbought territory. The CCI at 94 shows the same thing. The MACD, the daily MACD, is showing 2,189. That's a strong positive reading. But here's the divergence that concerns me. On the 5-hour chart, we are seeing momentum start to flatten even as price makes new highs. This is the first crack in the ARMA 4H timeframe. This is where the real action is. The 4H chart shows the Nikkei riding the upper Bollinger Band for 3 consecutive candles. That's extreme buying pressure. The Williams percent R at minus 0.619 is about as oversold as it gets. I mean overbought, sorry. When Williams percent R stays this high for multiple periods, it typically precedes a sharp mean reversion, support and resistance. Key resistance at 72,379. We are just 13 points away as I record this. Above that, 73,374 and then 75,334. Key support levels at 69,426, then 67,466, and 66,471. Here's what most traders miss about the Nikkei's current structure. The ATR is sitting at 1,912 points. That means a normal daily move is nearly 2,000 points. But we just moved 3,191 points in a single session. That's 1.7 times the average range. Exhaustion moves often happen after these outsized daily candles. The pivot point at 70,429 is your North Star for the next 24 hours. As long as we hold above that level, the bulls remain in control. But the closer we get to 72,379, the higher the probability of a sharp reversal. 2.4 fundamental driver and cross-linkage, 430 to 630. So what caused this explosion? The headlines say Japanese stocks higher at close of trade, but that's lazy reporting. The real driver is the Bank of Japan's policy divergence with the rest of the developed world. While the Fed and ECB are contemplating rate cuts, the BOJ is signaling that their normalization path remains gradual. The yield differential between 10-year JGBs and USDs is widening, and the yen is weakening as a result. A weaker yen is historically bullish for the Nikkei because it boosts export competitiveness and inflates foreign earnings. But here's the catch: we are now at levels where the weak yen narrative might be fully priced in. The cross-asset linkage that matters most right now is the Nikkei versus the dollar-yen pair. As US dollar to Japanese yen approaches 160, the Nikkei tends to rally. But if the BOJ starts verbal intervention, and I've been warning about this for weeks, the yen could snap back hard, and the Nikkei would follow. The 1 to 2 week directional lean is still higher, but with significant downside risk. I'd say the probability of a 2,000-point correction is higher than the probability of a 2,000-point continuation at these levels. The event that invalidates this bias, a BOJ speech that sounds even slightly hawkish, or a US dollar to Japanese yen break below 155. If that happens, this entire structure unwinds quickly. Do you think the Nikkei breaks above 72,400 this week? Comment yes or no. I'm tracking consensus. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1. The sniper, conservative. This is for traders who want high probability with defined risk. The trigger condition: wait for a daily close below the pivot at 70,429. That's the level that confirms exhaustion. Once we get that close, look for a retest of 69,426 support. The entry: enter short at 70,200 on a 1-hour candle close below 70,429 with the RSI confirming at 65 or lower. Stop loss: place your stop at 71,200, exactly 1,000 points above entry. This is above the pivot, giving the trade room to breathe but keeping risk contained. Target 1, 69,426, that's the first key support level. This gives you 774 points of profit with a 1,000-point stop, so the risk-reward is 1 minute and 0.77 seconds, which isn't great for a sniper trade. Wait, let me recalculate that. Actually, let me adjust the entry to be more precise. The trigger condition: price pulls back to the pivot at 70,429 and shows rejection, a bearish candle with a long upper wick. Entry: 70,300 on the bearish confirmation candle. Stop loss: 71,300 to 1,000 points above entry, above the recent high. Target 1, 69,426, 874 point profit. 1 minute and 0.87 seconds. Not enough. Target 2, 68,000, 2,300 point profit. 1 minute and 2.3 seconds. That's the real target. Invalidation: if we get a 4-hour candle close above 71,500, the setup is void. That would mean the breakout is real and we are going higher. The sniper, conservative. Entry: 70,300, bearish rejection candle at pivot. Stop loss: 71,300. Take profit 1, 69,426. Take profit 2, 68,000. Risk, reward: 1:2.3 hour invalidation, void if 4H candle closes above 71,500. Strategy 2, the active trader, standard. This is a pullback play for traders who want to buy the dip. Entry condition: wait for a pullback to the 20-day moving average at 68,781. This is a natural magnet for price after a strong rally. Entry: buy at 68,800 on a 1-hour candle close above the 20-day MA, with the RSI showing bullish divergence, meaning price makes a lower low but RSI makes a higher low. Stop placement: place your stop at 67,466, that's the second key support level. This gives you a 1,334 point stop, but the structure is clean. Target 1, 70,429, that's the daily pivot. This gives you a 1,629 point profit with a 1,334 point stop, so risk-reward of 1:1.22. Target 2, 72,379, the key resistance. This gives you a 3,579 point profit with a 1,334 point stop, risk-reward of 1:2.68. Trailing stop rule: once target 1 is hit, move your stop to break even. Then trail it using the 4-hour 20-period MA as price moves higher, invalidation. If the Nikkei breaks below 67,466, this setup is void. That would mean the daily structure has broken down. The active trader, standard, pullback play, entry, 68,800, 1H close above 20-day MA, stop loss, 67,466 take profit 1, 70,429 take profit 2, 72,379 risk, reward, 1:2.68 are invalidation, void if daily close below 67,466. Type your Nikkei range for tomorrow in the comments now. Let's see who's aligned. Strategy 3, the aggressor, high risk. This is for those who can lose small and manage risk aggressively. Entry, short at 72,350, just below the key. Resistance at 72,379, on a 1-hour candle with a bearish close and the RSI showing overbought above 70. Stop loss, 72,800, only 450 points above entry. This is a tight stop, and it could get taken out on a spike. Target 1, 71,000. This gives you 1,350 points of profit with a 450-point stop, risk reward of 1:3. That's excellent. Target 2, 70,429, the daily pivot. This gives you 1,921 points of profit with a 450-point stop, risk reward of 1:4.27. Here's why this matters. The Williams percent R is at -0.6, that's the most overbought reading possible. Short-term mean reversion is almost guaranteed, but the timing is uncertain. The tight stop gives you room to be wrong with minimal damage. Invalidation, if we get a 4-hour candle close above 72,800, this setup is void. That would mean the resistance has been breached and the next leg higher is underway. Warning, this is a countertrend trade. The monthly, weekly, daily, 5H, and 1H trends are all strongly bullish. You're fighting the dominant momentum. Only take this if you can handle a quick reversal and get out fast. The aggressor, high risk, countertrend, entry, 72,350, bearish 1H close, RSI 70, stop loss, 72,800 take profit 1, 71,000 take profit 2, 70,429 risk, reward, 1:4.27 are invalidation. Void if 4H candle closes above 72,800. Warning. Countertrend trade. All timeframes bullish. Never risk more than 1 to 2% per trade. No positions through the upcoming BOJ speeches or US data releases. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize what matters for the next session. The single most critical level is 72,379, that's the key resistance. If we break above it with conviction, the next target is 73,374 and then 75,334. But if we reject and roll over, the pivot at 70,429 becomes the most important support to watch. Tomorrow's focus, US durable goods orders and final GDP numbers. If those come in stronger than expected, the dollar could strengthen, putting pressure on the Nikkei through the US dollar to Japanese yen channel. If they're weaker, the risk-on rally could continue. If you want the full breakdown on how this Nikkei setup relates to the S&P 500 divergence and what it means for global equity markets, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.